Welcome to TMS Insights. It's reporting season, middle of February. Ben Clark and Jeremy Hook bringing the updates. What's been a busy season the last couple of weeks. Lots of reports, half year and full year. But also the market volatility, which we experienced in the front of February, has died a little bit. The market's recovered about 150 points. Certainly a lot calmer as we speak now at the end of Monday the 19th, and the trading performance of the day after last week, Ben, a lot more comfortable than we felt about 10 days ago.
Yeah, I think, certainly the international markets felt a much more severe sell-off than we did, which is good that it makes sense for once. They ran a lot harder than we have and they came back a lot faster.
Yeah.
I think with a number of our stocks, dividend yield started to kick in to help support. But also, of course, reporting season here started off, and so a lot of our stocks have taken their own trajectory outside of what the market's doing.
And that's pretty much what we said last time. We certainly were keener to focus on the stocks rather than the big macro that was coming out of the US, and that's what we will talk about now. So let's go through some of the key results from this season to date. Ben, last Monday we had REA Group. Today we had Domain Group, its listed competitor, which came to the market late last year. REA outstanding again.
Yeah, probably one of the top two results I've seen, I reckon. Very strong revenue growth as the Sydney and Melbourne housing markets price has dropped or slowed very significantly. We've seen a run in listing volumes. Depth continues to be a big thing for them. The business is excelling. And I thought Domain actually had a pretty good set of numbers as well today.
Which was encouraging because they lost their CEO in January. A bit of scandal surrounding the stock. Not what people wanted, but the outlook looks pretty good there.
Yeah, absolutely. I mean, Domain is a much more Sydney and Melbourne focused business, so it makes sense that they actually should be doing better than REA, which I'd say they're probably not at this stage. But, as they're spun out of Fairfax and hopefully as it gets its own improved culture and management, we'll start to see the results of that come through.
Yeah, that's good. Computershare was a really good result last week. The stock had run well. May not be so widely held, but it's one of those stocks that benefits, as we know, from a higher interest rate environment like we are seeing in the US. So thematically, one to consider.
Absolutely. And it sounds like the business fundamentally is, after several years, it really did nothing.
No.
They've invested aggressively, moved into new parts like mortgages and those sort of things. And the business itself sounds like it's really performing. And then you've got the tailwind of the interest rates on top of that. And as we've seen with QBE, where, a lot's been promised, if the business still has issues, you don't get that benefit.
Yeah, exactly right. Okay, good one on QBE. One we've listened to many times and been impressed with and told our viewers and clients about is Challenger.
Yep.
Last week reported, the story's good. The stock had run very well over the last year, so it didn't necessarily get a kick along, but we're pretty happy with where Challenger's placed at the moment, Ben.
Definitely. I think this is one of the good long-term growth stories. The annuities market, I think, almost inevitably will continue to grow quite strongly. They're the dominant player in it. And then you've got this new business venture of selling annuities to the Japanese, which is only just starting to be put together, but already some pretty amazing results. So that could be the next 3 to 5 years of growth for them, but really well managed. I think it's a great business to own.
Yeah, great.
And good on this pullback.
That helps. Yeah, makes value opportunity. So that's good. Woodside reported last week, announced a rights issue, didn't trade for the back end of the week, came back today, was down, not as far as obviously the rights issue. So existing holders of Woodside will get the opportunity to buy 1 for $9 at $27. Big raising, $2 billion. Woodside, overall quite good numbers, but maybe not a lot to kick it on, but probably a value buy after this fall.
I'd agree, Jeremy. I think now is the time you get interested in Woodside. I think for me it's more a 1 to 2 year trade rather than a long-term portfolio stock, but others would disagree with that. It's a very capital-intensive business, but I think if you look at where the share price is versus where the oil price is, it looks pretty well priced. And, with the capital raisings you said they're doing, that's put pressure on the share price and masked probably what was a reasonable result. So, I think Woodside looks pretty interesting.
Yeah, great. Yeah. In the top 20 again, outstanding result, record highs CSL.
Yeah.
So, again, the story's got better and better. It's been a good year for the stock and a good year for the operations of the group. Outlook statement, fantastic. So there's a lot more in store.
Yeah, I mean, it's now a $65 billion market cap company and it grew its earnings per share by 32% the first half of the year. It's just phenomenal growth. And the CEO continues to be incredibly up. I mean, he said again, the the next 10 years for CSL the most exciting I've seen. They've got Brian McNamee's come back as the chairman. It just seems to be a company that's in, everything's lined up. The valuation is a bit stretched.
That's what's hard, yeah. But it's well loved for good reason.
Absolutely, yeah.
In Origin, really good turnaround in the operating performance of the company. Share price has led that, which often happens, as we explained. So, but again, positioned well. Another energy stock that is quite investable at the moment.
Definitely. I mean, I actually think this could do a bit better than Woodside in the next couple of years. Debt's now guided to be less than $7 billion by the end of the year. APLNG, they said, will have a break-even oil price production cost of less than $24 a barrel by the end of the year. And the core energy distribution business grew its earnings 21% the first half of the year. So there's kind of an upgrade cycle happening right across the business. Yeah. And I think it's off the radar of Insto still because of debt, lack of dividend, all these kind of things. But as that starts to change, you could keep getting a re-rating in Origin.
Good one. Today, Invacare reported that was a stock that has been quite volatile of late for such a steady business, and one we followed for a long time. The market was a little unimpressed and sold the stock down. Probably we've argued that valuations have been an issue, and we were quite happy at higher prices letting go of a few, but Ben values returned to Invacare.
Yeah, I definitely think it's now looking on the buying radar again. The main news today is that the CEO has said that they're going to accelerate investment across their properties. And what they're effectively doing is refurbing a lot of properties. So they're having to close properties, and they won't be making any money out of them, and they're having to spend money on them. So, they've guided for a flat year, but if you're a longer term shareholder, and we've seen in the past of businesses like Seek and REA, they go through periods where they need to invest, and the long-term returns hopefully will warrant that investment. And, a comment he made on the call, I think today, was 10 years ago when you went to a funeral, you wanted a cup of tea and a biscuit. Now people want champagne and hot catering food. They need to put kitchens into all of these centres and do things like that. But over time, they'll get return on that investment, and hopefully the share price will wake up to that.
Yeah. That's good. Telstra reported mixed numbers, obviously quite a sea change from the Telstra of the past. So loss of market share, loss of margin a bit. The dividend now quite reframed. A new Telstra, did you like it?
Well, I thought it was better than other recent results. Yeah. And look, the jury's still out on this one, I think.
I think that's right. And in the sea of opportunities, to me, Telstra doesn't stand out in any way, and I think that's the reality. We've told about a lot of stocks that look pretty interesting, and maybe this one's less interesting, although there's still a yield that makes sense to hold for income purposes. Right, well, that's all we've got time for in this video today. We've got obviously another week and a half of busy reporting, and we'll be updating you all with more news when that arrives.